Hi, it's Arjun. Last week, we published a written post that took a fresh look at what's been a long-standing theme of ours, what we've called obliterating peak oil demand. We dug into OPEC Research's recently published World Oil Outlook report and wanted to compare it to OPEC more optimistic view of oil demand, which is very much in line with our own perspectives, with more bearish forecasts, most notably from the IEA, but frankly, a number of leading energy voices, including some of the largest majors, especially in Europe, have had much more bearish oil demand outlooks. And we wanted to compare and contrast these reports. OPEC's been very aligned with us in recognizing energy's natural hierarchy of needs. Everyone wants energy 24/7, 365. And the starting point, both in that OPEC woo, as it's called, or our analysis is, what does it mean? What does it take? What are the prospects for everyone on Earth someday becoming energy rich, and then going through your order of operations. This idea that when only the lucky 1 billion of us are fully rich and the other 7/8 of the world, the other 7 billion people are aspiring to kind of lifestyles we lead, the idea that with that kind of backdrop, that anyone, any forecasting energy agency or company or anyone else for that matter, can know when we're going to have peak demand and somehow think it's going to happen within the next 3, 5, 7 years. We push back hard on that. And that was essentially the point of last week's written post. That post has raised a number of questions, and we're going to address 5 of them today. So the first question I get asked is, hey, Arjun, why are you trusting OPEC Research in the first place? They're obviously a producing, exporting oil group of countries. Aren't they just talking their book on the need for oil demand to grow or the likelihood of oil demand growing and prices may rise and all these kind of things? And I'd just say, I've had the good fortune, and frankly, it's a lesson I learned from my Goldman career, some great advice from our lead general counsel at the time, which is to evaluate people, to evaluate things based on firsthand experience. And I've had the good fortune to interact directly with the folks in OPEC Research, and for that matter, the people at the IEA, at the major oil companies and their economics groups and so forth. And I'd say with everything, I'm just going to judge them based on what I can see their analysis shows. I appreciate that in the case of OPEC Research, they have started with the view of primary energy demand and have looked at, here's what's going on in the OECD and the rich world, and here is their estimates for the pace of development and what they're seeing in the developing world, which frankly, given their producer status, I think they have as good insight on that as anybody. And I'm going to contrast it, especially in the last 2 to 3 or 4 years, where certainly it's true of the IEA, but frankly, it's true of a lot of the major oils that publish similar analysis. They started with CO2 and, quote, energy transition as the defining objective. And as we've now exhaustively stated, solving for CO2 is no one's first objective. You can think it's an important objective. You can not think it's an important objective. It frankly doesn't matter. Everyone on Earth, all 8 billion people, all they care about is, do I have energy today 24/7, 365? And as we've said, there's the lucky 1 billion of us who can take that question for granted. And there's the other 7 billion people on Earth who are trying to move up those economic and energy S-curves and to have essentially the kind of abundance in energy and therefore lifestyles that we take for granted. And what I'm appreciative of the OPEC report is that it starts with that type of framing. It does discuss other considerations, whether it's affordability, geopolitical security, as well as some of these environmental concerns, but it starts with this analysis of what does it mean for everyone to someday become energy rich. And so our own views are very similar to OPEC Research. We have somewhat jokingly suggested they may benefit from a branding name change. But at the end of the day, I think OPEC itself, as we wrote about last week, has changed a lot. People still remember, even if you didn't live through it, and I was young when this happened, the Arab oil embargo years and this notion of, quote, a cartel, which is the prevalent descriptor in the Western media, that idea of OPEC, I think it does create, at least in the Western world, a kind of a negative branding toward the group. And I think I view it today as really an institution that is there to represent non-Western interests. And again, that's they're entitled to that. The rest of the world is entitled and should have their own institutions that reflect their emphasis on how they're going to want to economically grow. And so I think OPEC Research does some excellent work, and I would encourage people to simply read it and make their own conclusions as they go through it. I think the second big question that really jumped out to people was our noting that for the first time in our 33-year career, we're highlighting the potential for African oil demand growth. And I noted that in some recent upward revisions to historic demand in the IEA's monthly oil market report, that Africa featured for the first time in a meaningful way and kind of eliminated a whole bunch of, quote, missing barrels, or, that discrepancy between demand less supply and inventory changes. The fact that Africa for the first time is becoming noticeable, it's good news. There are 1.4 billion people in Africa who use amongst the least energy per capita as anyone on earth. And it's a region, it's a continent, 54, 55 countries that are going to grow from 1.4 billion to 2.4 billion people. And they're using, in oil terms, just 1.1 barrels per capita. Africa today consumes about 4.5 million barrels a day. They actually produce over 7. So they're actually supplying more oil to all of us in the rest of the world, and they are consuming themselves as a country. There are many reasons for that are beyond the scope of this video. Some of them have challenging governments. Some of them have suffered from Western and other influences and negative examples of that over the years. That's, it's beyond my scope as an oil equity analyst to go through all of that history of why Africa is in the situation it is. What I will say is, to the extent some of those countries are starting to move up economic and therefore energy S-curves, this is undoubtedly good news for the people of Africa. And what struck me in the OPEC World Oil Outlook report is that the future, the expected demand growth from Africa as a continent was starting to become noticeable in the demand numbers. And so many people will say, hey, OECD's mature, China's maturing. We largely agree with those perspectives. And they'll also say, well, India alone is not going to make up for China. And we agree. I think India is going to grow, but it's going to grow at a slower rate, a slower ramp than did China. But there's still the rest of Southeast Asia, there's Latin America, there's Middle East, and there may actually be Africa. So what I have here is an exhibit we showed in one of our original 1.4 billion people club reports, or the Lucky 1 billion reports. And on the far right, you can see Africa, 4.4 million barrels a day. This is 2023 data. If they were to use various increments on a per capita basis, you're talking massive future growth in oil demand. Is Africa ever going to get to 10 barrels of oil per person? We can only hope so, because it will mean the continent is healed and that the people in Africa get to enjoy, again, the kind of lifestyles we take for granted. But maybe there won't be an incremental 60 million barrels a day of oil demand. It doesn't take that much economic improvement from too much of that region to really become noticeable on the oil demand stats. So you can look at the increments here, 16 and an incremental 14, an incremental 17 and 17, depending, again, how far up that S-curve you move. But it's a massively important region, and I think one we should start paying more attention to. The third question we get is, if you are right about oil demand, if OPEC is right about oil demand, it's going to continue to grow, where's the supply going to come from? And the short answer is, with exploration having been basically gutted at a lot of the Western oil companies and then some, oil supply is going to have to come from existing areas, at least for the time being, at least until we get a new exploration cycle going in a meaningful way. And so that's the countries you see listed here, which have accounted for essentially all of the net oil supply growth over the last decade. And of course, most of it, if not all of it, depending on exactly how you're adding things up, have come from U.S. shale oil. And that is essentially Texas and North Dakota. It's really remarkable how important those areas have been. Right now, the debate is Tier 1 shale maturing to the point where it's going to struggle to achieve these kind of historic growth rates? I don't think anyone expects shale oil Tier 1, meaning it works underneath $70 oil, to grow at anywhere near these kind of historic growth rates. But there's Tier 2 and Tier 3. What is the price to really get those going? It's probably not an extra $5 in the oil price. Whether it's 10, 20, 30, 40, who knows? But it's going to take somewhat of a price cycle. Canada, hopefully under new leadership, we shall see if they can be committed to improving their pipeline and export infrastructure. There's a lot of scope for Canada, which has steadily grown, to accelerate that growth rate. And of course, we have Iran, Iraq, Brazil, Guyana, UAE, and some of the other countries as well. There's geopolitical risk in all of this stuff. And at Veriten, we'll circle back. We have a colleague who has some Russian expertise. We're going to circle back on Russia, which is perhaps showing some signs of maturity. But with any of these places, whether it's a Western place or not, A lot of this is going to be boiling down to what are the price incentives, what are the fiscal regimes, and what is the appetite for companies to take on some risk to figure out where you're going to find your next barrel of oil. It's a really big call from a corporate standpoint. Do you believe this business is maturing? Do you think we're about to plateau and it's going to go away? You're going to have a very different outlook as a management team and as an investor if that's your view. If you share our view and OPEC's view, that this business still has a long way to go in terms of future growth potential, then it's really a question of if you want to be a going concern, if you want to be around for that, especially the next big upcycle whenever it comes, where do you want to go find oil? And these are the established areas. I think other things we should mention, Alaska, other Arctic, deep water, and I had one more on my list, global shale. Is shale ready to start getting developed in other parts of the world? Let me go to my next slide and we'll address that a little bit. So I get the question, okay, I hear you that tier 2, tier 3 shale, Canada, yes, we're gonna have to find more oil where we've already found it, but what are some out of the way areas, maybe on the deep value side, that are catching your attention? I wanna highlight two that face significant geopolitical risk that definitely is not gonna be for every company out there. One of these areas may be just more for private equity. The other one I think might be for major oils, and that is the socialist states of Venezuela and California. Let me start with Venezuela. I think some of you will remember in the 1990s, this was a real attractive boom area for the oil industry. Luis Justi, ran PDVSA, I want to say he was also the energy minister, was kind of the opening of Venezuela, and there were a bunch of really fantastic deals and project areas. They had attractive fiscal terms, and this is heavy oil that cold flows, meaning you don't have to heat it up like you do in Canada. It cold flows. I think with horizontal drilling, it's several thousand barrels a day per well. And this generally heavier oil is very well suited for the US Gulf Coast refineries. And there was a lot of transactions. The names were Hamaka, Petrozuata, Cora Cora. There was a handful of others where a major oil had the upstream development and then often had the back end at the refinery on the Gulf Coast as well. And when President Chavez came into power, that sort of ended up killing these types of opportunities. Most of it was either nationalized or de facto nationalized. And, you fast forward, and it's the purple line here on the left axis, Venezuela grew dramatically to, over 3 million barrels a day, nearly 3.5 million barrels a day of total liquids by the late 1990s. And that was the peak. And then once Chavez came into power, once they started nationalizing this stuff, production was on a slow decline until more recently when it's been on a really fast decline. And we don't know when Venezuela is going to be attractive for investment again. It may not be for another decade or even 2 decades, but the oil's attractive. The alignment with the US Gulf Coast refineries is an obvious one. And I think the question is, and this strikes me as something more for larger companies who might have the ability to do both the upstream and the downstream, how do they think about this as sort of a really attractive future long-term opportunity? Again, probably beyond the current administration there. We're not going to get into Venezuelan geopolitics in this 5 seconds, but you want a deep value out of consensus idea. I'm going to say that this used to be some fantastic oil projects that a bunch of integrated oils owned back in the day. I think the other area that is sort of catching our attention is California. It is true that California is generally mature, but it was once producing, and this is on the right axis, over 1 million barrels a day of liquids, maybe going back a little bit before this graph started. And it's been on a slow decline for a bunch of time, and it's now in a somewhat faster decline. And we are noticing that Governor Newsom has recognized that with some of the shutdowns of the refineries in California that have been recently announced and that had occurred in recent years, as well as at least some green shoots on permitting, oil well permitting. We'll see, a lot to be determined, that maybe, just maybe, there's a recognition that this is actually really important industry for the US and for the state of California. I don't know that we're going to have a boom in California. We're not expecting, Texas or North Dakota-like results. But when you look at how much duress and how much against the oil industry the leadership in California has generally been going back, over a little bit of time here, I'm just going to put this in the deep value type category. And again, perhaps more for private-oriented companies, we shall see. But I wanted to highlight California. And the third line we have on here is Argentina. And Argentina has probably had its own sort of extreme socialism versus less so challenges over the years. And of course, we've now got President Milei, who has really turned around the country as best as we can tell. But frankly, preceding Milei, since 2019, the Vaca Muerta, this is an international shale oil play in Argentina. It's usually been compared to the Eagleford shale in Texas in terms of some of the reservoir and rock property characteristics. It's always had the promise. And for the first time, you're starting to see some noticeable growth. And so our point in mentioning Argentina here is you can be faced with significant geopolitical challenges, but it is possible for these things to turn around. We don't know when Venezuela is going to turn around. We've really always loved that heavy oil there and the integration with the refineries. And then I think California is starting to wake up to the fact that their own energy transition narratives, I'm going to call it the foolishness of low carbon fuels, the renewable diesel and ethanol and this kind of stuff, not at all obvious that helps the environment even one bit, and it may even hurt the environment. But let's put that aside. Hopefully California is in the process of rethinking their challenged geopolitics. I think the last topic I want to address, and this is going to be, I think this should be a standalone video at some point in time. It's a little bit of a what if. What are maybe some of the lessons and opportunities, as well as perhaps the regrets from the Super-Spike area, the namesake for this very publication? And I'm thinking back to how much the current environment feels like that kind of late 90s, early 2000s, pre-super cycle era, where it was a really challenging time for industry. European demand was starting to mature. Japanese demand was starting to mature. And it wasn't quite the diehard peak demand forecast that we have today, but a lot of questions on how healthy oil demand was going to be. And then the idea was, well, you had to become a super major. A lot of that got kicked off in consolidation. And you're hearing a lot of those in order to survive and thrive. And you've seen a lot of those kind of same themes talked about today. And we want to do the what if of what if things had gone differently. And again, I think this is just going to be a teaser for a future video, but I want to highlight the three companies here. Mobil, which ended up selling to Exxon, Amoco, which sold to BP, and Oxy, which remained independent, as three different approaches, or three approaches that were taken. And if we had to replay it all, what would you do? And I'll just say this. I think in the case of Mobil, this was a very well-regarded company at the time. People liked Lou Noto and the management team. They had confidence in them. And I think the thought there was, hey, we're going to partner with the leading company of the day, Exxon, and the company that frankly had been the leading energy company, top 3 S&P 500 stock since it was spun out of Standard Oil as Standard Oil Company New Jersey. Mobil was Standard Oil Company of New York. Exxon had been the leader throughout the industry, and here was a chance for Mobil during what was a challenging time for industry to ensure that the future of Mobil was part of a combined ExxonMobil. And you can argue that Mobil could have stayed independent. Maybe they could have bought Amoco or done some different trajectory and still been a viable company. I'm going to say that while the 2010s turned out to be a more challenging period for ExxonMobil, I'm going to say that I don't know that you'd change anything about this merger. And that Mobil combining with Exxon was an excellent outcome. Exxon's back to being and still has remained the #1 stock in terms of market cap and sort of positioning within the industry. And I'm just going to say that I don't know that you do anything different. There's the quick answer there. We'll try and show some numbers and go through that maybe in a future video. Amoco's the one that really sort of bugs me in the sense of, was it the right call to sell to BP? And that's always the question. Do you accept a premium? No investor would be, almost all investors say, hey, I got a stock today and someone's offering to buy it at a premium. That's a good thing, right? Is it always a good thing? Are we sure about that? And so it's easy to say today BP's run into some challenges, so it's a bad idea to have sold. I'm just going to focus on that first 10 years after the merger. And at the time in the late 1990s, the view was US mature, you have to be international. And a lot of the companies that were below the tier, so the leading international oils, as we called them then, were Exxon and Mobil and Chevron and Texaco and Royal Dutch Shell and BP. And then you had what we call domestic integrators like Amoco, Arco, Kerr-McGee, Unocal, Phillips Petroleum, Occidental Petroleum, and a few others that I'm going to forget right now. And Amoco was in that sort of domestic integrated category. But it turned out that they sold just before the shale revolution really took off. And I am still struck by how many people, and these were people who were not part of the senior management. I want to say it was Larry Fuller was the CEO. These are people who were not part of that senior management team, who I run in today. They are at E&P companies and at other companies, and some of them are on boards and elsewhere, these are just some of the best executives that I've come across in my career, all ex-Amoco. It had a phenomenal bench of really great leaders who went on to a number of different things that other E&Ps or other companies are now serving on boards or what have you. And you just wonder, what if they'd had a different management, senior leadership team and board at that time, and it made a different decision to have not sold to BP? That's the one. Amoco's the one that really, I feel like what the 2000s became would have been very well suited to who they were. That's a what if. We need to show some numbers and analysis and dig into it more, but we're going to, that's the one that sticks in my mind in the regrets bucket. The last one I want to briefly highlight, and I talked about this in December of 2021. Super-Spiked was only a month old, and the report title was Dumb Calls I Made as a Stock Analyst, and we had really gotten Oxy shares wrong in this time period. And I'm going to do the short version of this. I'd refer to that note. But Oxy was not a good company in the 1990s. They significantly lagged. People did not have confidence in the CEO at the time, Dr. Ray Irani. And if you had told any investor in the late 1990s, hey, Oxy can get taken out for a 30 or 50% premium, people said, absolutely, get him out of here, no brainer. They did some, at the time, controversial transactions. They bought Elk Hills in California and El Toro, which is a Permian Basin property. And they bought them. People thought they paid too much. I thought they paid too much. My friend Neil Maida could probably still send around the notes if he has them on the Goldman system, where I was poo-pooing these acquisitions as essentially bad deals for Oxy. And it turned out to be a home run. Oxy ended up rising 9x over the course of the subsequent super cycle. So it gets that same question. If you're a company that thinks the business is going away and that you can't fight to live for another day on your own, or you don't want to, the near-term premiums can always seem nice, 30%, 50% if that's what you get. Maybe today you only get 15 or 20%, who knows? Everyone would have signed up for Oxy taking a premium. And in fact, the stock was an absolute home run into that super cycle where suddenly Elk Hills and El Toro were clearly no-brainer great deals. We all didn't know the great and the late Steve Chase, and one of my favorite executives I've come across in my career, who sadly passed away a few years ago. But the discipline he brought to Oxy as CFO in conjunction with Dr. Irani, the track record speaks for itself over that time frame. So these are the kind of things we need to spend more time on as we think about what is the appropriate corporate strategy, what is the takeaways, lessons from investors in terms of how this business can really change from what everyone thinks they know the environment is, as they thought in the late 90s, as they think today, to what it could be a decade ahead. And how do you make moves that may not be popular at this exact moment? And how do you have a 9-bagger like Oxy did? I mean, they deserve a lot of credit. And as I said, dumb calls I made as a street analyst. We did not support those moves that Dr. Irani had made at the time, and we were wrong. We were wrong really, really badly. It's a phenomenal stock. I mean, we ended up recommending it at some point. It was way too late. So we'll do more on this, hopefully in coming months and so forth. I think there are a lot of lessons to learn from the last super cycle and the period that preceded it. So I'm going to end this video on a personal note. And it was a sad week in the music world with the passing of John Michael Ozzy Osbourne. I had the great fortune to see him twice in my life. The first was on the Bark at the Moon tour. I want to say it was like 1985 or 1986. It was at Brendan Byrne Meadowlands Arena, and Metallica was the warm-up act. That was the Master of Puppets tour. Metallica was phenomenal. It was a short set, but people definitely came to hear them as well. And I'm very lucky and happy to have caught Ozzy. And then these pictures that you see here, these are from Black Sabbath, a reunion tour in 2016. This is from Madison Square Garden. So I am, Black Sabbath was founded in 1970. I was born in 1969, and Oxy was kind of kicked out of the band in, I want to say 1979. I was 10 years old at the time. And so, when I started kind of listening to my own music, if you will, that's really sort of late elementary school, middle school. So most of my life has been Ozzy as a solo artist, but I think Black Sabbath is really perhaps the pioneers of heavy metal. I'm lucky to have caught them at MSG. And so want to say rest in peace, Ozzy. Thank you for all the impact you've made in the music world. And I'm not going to play it here because I think YouTube and Spotify will block this video. But if you go to Super-Spiked or go to Veriten, you can click on the link and you can at least get War Pigs from MSG back in the day. Thank you.